Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're starting a discussion about business valuation, which can seem complicated, but is really about understanding the true worth of a company. To help us picture this, think of a small stack of blocks representing different parts of a business, with one block on top showing growth and progress. As we go through the presentation, we'll break down the key factors that drive value, how to assess them, and why this matters, whether you're buying, selling, or managing a business. Let's explore how all these pieces fit together to give a clear picture of a company's value. In today's business world, knowing what a company is really worth is crucial. Whether a company is preparing for a sale, seeking investment, planning a merger, dealing with shareholder issues, or making strategic choices, having a clear valuation guides better decisions. Valuation is much more than just plugging numbers into a formula. It requires a mix of financial analysis, market understanding, strategic thinking, and making informed predictions about the future. Unlike public companies whose market value is constantly tracked through stock prices, private companies need more structured methods to figure out their worth. This involves looking at things like how steady their cash flow is, their potential for growth, the risks they face, their position compared to competitors, the quality of their management, and the industry they operate in. Since valuers might use different assumptions or methods, valuations can vary. Throughout this video, we'll break down these concepts in a straightforward way, showing why valuation matters, explaining the main ways to approach it, demonstrating how it's done in real life, and reviewing examples along with the pros and cons of each method. The aim is to help you understand the principles behind valuation and how they apply in everyday business decisions. Business valuation is a practical tool that supports many vital business activities. It helps leaders understand what drives value and guides them in protecting or growing it. When considering strategic moves like acquisitions, divestments, or entering new markets, valuation offers a clear way to compare options based on their impact on cash flow and risk, helping focus on long-term benefits rather than just quick gains. In mergers and acquisitions, valuation is key to setting fair prices. Sellers use it to justify their asking price, while buyers count on it to avoid overpaying. For raising capital, investors rely on solid valuations to measure risk and potential returns, so having a credible valuation builds trust and openness with funding partners. Additionally, valuation is essential for financial reporting tasks like impairment testing and share-based rewards, where accuracy and strong support are required by regulators and auditors. Lastly, valuations play a crucial role in legal and tax matters, such as disputes, estate planning, and tax assessments, where the process must be objective and methodologically sound to hold up under scrutiny. All these uses show that valuation is much more than theory. It is a vital part of making smarter, more informed business decisions. When it comes to valuing a business, there are three main approaches that people commonly use: income-based, market-based, and asset-based. Income-based valuation focuses on the company's ability to generate future earnings or cash flow. One popular method here is the discounted cash flow approach, where you project future cash flows, estimate a terminal value to capture what happens after the forecast period, and then discount all those amounts back to their present value using a rate that reflects the risks involved. This method is strong because it's based on fundamental financial performance, but it can be quite sensitive to the assumptions you make about growth and margins. Another income-based method is capitalization of earnings, which is simpler and works well for businesses with steady, predictable earnings by dividing normalized profits by a capitalization rate. It's less detailed than discounted cash flow and less suited to companies with fluctuating or high growth. Often, valuers use a combination of these methods to get a more comprehensive picture, balancing the advantages and weaknesses of each one. Market-based valuation methods estimate a company's worth by looking at how similar businesses are valued in the market. One common way to do this is through comparable company analysis, where we use valuation ratios like EV, EBITDA, or price to earnings from companies that are publicly traded or privately held, but similar to the subject company. We adjust these multiples to account for differences in size, growth potential, and risk. Another approach is precedent transaction analysis, which looks at actual sales of comparable companies to find valuation multiples. This method reflects real-world deals, but can sometimes be influenced by specific factors unique to those transactions, like expected synergies or urgent sales. Both methods rely heavily on having relevant and up-to-date data about comparable businesses, making them very practical and aligned with current market conditions, but also somewhat dependent on data availability and quality. Asset-based valuation looks at a company's value by focusing on its assets minus its liabilities. One common method here is net asset value, which adjusts the balance sheet to reflect the current fair market value of what the company owns and owes. This approach is especially useful for businesses that hold significant tangible assets, like real estate or investment holding companies, or when a company is being liquidated. However, while it gives a reliable minimum value based on physical assets, it often overlooks intangible factors like brand reputation, customer loyalty, or intellectual property, which can also contribute significantly to a company's worth. This makes it a solid starting point, but one that might not capture the full picture for companies relying heavily on intangible assets. A professional business valuation is a careful process made up of several key steps, rather than relying on any single formula. First, it's important to clearly define the purpose of the valuation, whether that's for a sale, investment, litigation, or tax reasons, because this influences the methodology and assumptions used. Along with this, the appropriate standard of value is selected, such as fair market value or investment value. Next, the business and the industry it operates in are thoroughly understood by looking at the company's business model, competitive strengths, customer base, management team, and industry trends. This qualitative insight provides a foundation before diving into the numbers. After that, historical financial performance is analyzed, reviewing past financial statements to assess profitability, cash flow, and capital structure. Non-recurring items are adjusted to get a clear picture of normalized earnings. Based on this, financial forecasts are developed using realistic assumptions about key factors like revenue growth and expenses, because overestimating these can weaken the valuation's credibility. Then, one or more valuation methods are selected and applied depending on the business type and available data, whether income-based, market-based, or asset-based approaches. Finally, the values derived from different methods are reconciled to arrive at a final valuation range, using professional judgment and thorough documentation to support the conclusion. This structured approach ensures the valuation is disciplined, credible, and relevant to the situation at hand. In the first example, a family-owned manufacturing business is looking to sell a minority stake to a private equity investor. Here, the valuation uses a discounted cash flow approach that shows steady cash flows but only moderate growth potential. At the same time, market comparisons indicate lower valuation multiples due to the cyclical nature of the industry. The final valuation balances these insights to reach a fair price for both the seller and investor. In the second case, a high-growth technology startup is valued quite differently. Because it has little profit but rapid revenue growth, the focus is on market-based multiples and forecasts of future revenue instead of traditional asset-based methods, which aren't relevant due to the company's intangible assets. Finally, in a shareholder dispute within a professional services firm, an independent valuation adjusts partner compensation and uses a capitalization of earnings approach. This provides an objective and transparent basis to resolve disagreements fairly. Together, these examples show how different valuation methods apply depending on the business type and purpose of the valuation. Valuing a business brings several important benefits that help guide better decisions. It clarifies the main factors that influence a company's worth, making it easier to understand trade-offs when choosing between different options. A well-prepared valuation also builds credibility, as it shows investors, lenders, and regulators that the company's value is based on solid evidence. Additionally, valuation reveals potential financial and operational risks, which helps in managing those risks proactively. When negotiating deals, having a clear, evidence-backed valuation provides strong leverage and supports fair discussions. Finally, it encourages a focus on long-term strategies rather than just short-term profits, helping the business plan for sustainable growth. This structured insight is crucial, especially when navigating complex financial decisions or planning for the future. Business valuation has several limitations to keep in mind. First, it involves a lot of subjectivity because it depends on assumptions and judgment, which means different analysts might come to different conclusions. Small changes in these assumptions can lead to very different results, making valuations quite sensitive to inputs. Data can also be a challenge, especially for private companies where reliable information or comparable transactions might be limited. In addition, obtaining a professional valuation can be costly and take significant time and effort. Lastly, even though valuation reports often present precise numbers, they might give a false sense of accuracy because underlying assumptions are always estimates rather than concrete facts. Navigating business valuation involves more than just applying technical models. It requires a deep understanding of the business itself, its risks, and its growth potential. Valuation methods give a structure and help analyze data, but they don't tell the whole story on their own. Since no single approach perfectly captures a company's worth, professionals combine different methods and use their judgment to arrive at a balanced view. For business owners, investors, and decision makers, valuation isn't just about a final figure. It's a strategic process that uncovers what truly drives value and highlights ways to improve it. When approached carefully, valuation becomes a powerful tool that supports smarter decisions, more transparent negotiations, and sustainable growth, especially in a market that's both competitive and uncertain. Hello. If this video was useful, you'll find some more useful business and finance topics on the channel. And thank you very much for watching.